Easy Wealth Podcast, where learning about money feels easy.
Hey everyone, welcome back to the Easy Wealth Podcast, where we talk about money and wealth in a simple way. I'm Emma, and here with me as always is Jack.
Hey everyone, and Emma, I need to confess something before we start.
Oh no.
Last week, I almost sent money to something online. It promised guaranteed 100% returns in 30 days.
Jack, don't be lured by high return scams.
I know. I caught myself. But for about 3 minutes, I genuinely entertained it.
3 whole minutes.
You know, the website looked incredibly professional. There was a countdown clock, ticking. Only 7 spots left. I could feel my finger moving toward the button.
Oh no, the urgency trap, designed to bypass your brain entirely.
And it worked, on me, who has been doing this podcast for months.
And that is exactly why today's episode matters. Because if it can almost get Jack, imagine what it does to someone who's just starting out and hasn't built up the filters yet.
Yeah, arm the brain first.
Very true. Before you put a single pound into anything, remember there is no such thing as zero risk. Anywhere. Ever.
Okay, but I think most people's instinct is, I'll just keep my money in the bank. Safe. Done.
And that instinct makes complete sense. The number in your account doesn't go down. Feels solid. Feels responsible, even.
So what's actually wrong with it?
Here's the risk nobody talks about. Every year, prices go up. Groceries, rent, transport, everything costs a little more.
Inflation?
Yes. If your money is sitting in savings earning 2%, but inflation is running at 4%,
Your money is buying less every year, even though the number looks the same.
the number stays the same. The purchasing power shrinks, slowly, silently. Like a slow leak in a tire. You don't notice it until one day the tire is flat and you think, how did that happen?
Oh, that image is so good. You're driving along feeling completely fine.
And suddenly you're stuck on the side of the road wondering where all the air went.
That's exactly what happens to savings that aren't growing. They look fine until they're not.
Exactly. So doing nothing, keeping everything in cash, is also a decision with its own cost.
The risk doesn't disappear. It just changes shape.
And becomes invisible, which is almost worse.
So if everything has risk, how do people compare them?
Think of a simple risk ladder. Cash savings, government bonds, corporate bonds, broad stock market index funds, individual stocks, leveraged investments, speculative assets. As you move up the ladder, potential returns increase, but so does risk.
Okay, so zero risk doesn't exist anywhere, not even in the bank. And once I accept that, what do I do with it?
The question changes completely. It's no longer, how do I avoid all risk? It becomes, how do I find the right balance between risk and reward for me right now?
That feels like a much more useful question, actually. Okay, help me understand the relationship. Why does more reward always come with more risk?
Simple version. Imagine you're lending money to 2 people. Person A, steady job, owns property, perfect credit history, never missed a payment. Person B, between jobs right now, some debt, has missed payments before.
Person A sounds safe. Person B sounds risky.
Right. What interest rate do you charge person A?
Low. I'm confident I'll get paid back.
Low risk, low reward for you. Now person B?
I'd charge a lot more, because there's a real chance I never see that money again.
Higher risk, higher reward required. Otherwise, why take the chance at all?
Oh, the higher reward is the payment for taking the extra risk.
They're inseparable. You cannot have one without the other. That's the fundamental rule of money. So when someone promises you high reward with zero risk,
They've broken the rule.
either they don't understand investing, or the risk is hidden somewhere you can't see yet. It doesn't disappear, it just gets disguised.
That's the scary one, the disguised risk.
Always the scary one.
Okay, so we know risk and reward are linked. Zero risk doesn't exist. But here's what I want to know. Where do investors actually go wrong? Like, in practice?
Good question. Because most investing mistakes don't come from bad analysis. They come from three specific misunderstandings about risk itself.
Go on.
First mistake, confusing volatility with risk. Most people see the price drop and think, risk just went up. See the price rise and think, safe now. But that's not what risk actually is. The real risk is the possibility of permanent loss of capital, not temporary price swings. Those are just noise.
Oh, so a stock dropping 20% isn't automatically more risky?
Not if the company is financially solid. Strong cash flow, low debt, good fundamentals. The price dropped, but the business didn't change. In fact, Howard Marks, one of the greatest investors alive, put it brilliantly. He said risk isn't the price movement you can see. It's the loss you can't yet predict. Imagine two houses. One drops 20% because the whole neighborhood market is weak. The other hasn't dropped yet, but the roof is leaking and the foundation is cracking. Which one is actually riskier?
So the dangerous company isn't the one whose price dropped. It's the one with heavy debt and deteriorating cash flow, whose price is still going up.
Exactly. The risk is hidden, and that's the most dangerous kind.
Invisible risk again.
Always invisible risk.
Okay, mistake 2?
Overconfidence. And this one, I have to be honest, I lived this myself.
Come on, story time.
Not my finest chapter. Many years ago, I had a stretch where everything I touched seemed to go up. I picked a few stocks, they did well. I thought, okay, I've figured this out. I'm good at this.
Uh-oh.
So I got more aggressive. I started using leverage, borrowing money to invest more than I actually had, because I was so sure.
And?
The market turned, and it turned fast. And suddenly, I wasn't just losing what I'd invested, I was losing more, because leverage works in both directions.
You amplified the loss the same way you'd amplified the gain.
Yes. And the worst part? I had completely ignored the worst-case scenario. I never asked myself, what if I'm wrong? What happens then? I was so focused on the upside that I just stopped thinking about the downside.
Because when things are going well, the brain stops asking hard questions.
That is exactly it. And that is the trap. Market history keeps proving this. The most dangerous moment isn't when everyone is scared. It's when everyone feels like there's no risk at all. That's when the real risk is highest.
When you feel invincible, that's the warning sign.
That feeling of invincibility is the warning sign.
You really do learn from your mistakes. It's a valuable lesson. Okay, what is the third mistake?
Focusing on return and forgetting the return-to-risk ratio.
The ratio?
Most people ask one question before investing. How much could this go up?
I definitely ask that question.
But the more important question is, if I'm wrong, how much do I lose?
Oh, so it's not just the upside. It's the upside versus the downside.
Yes, think about it this way. Two investments. Investment A, potential gain of 20%, potential loss of 10%. Investment B, potential gain of 30%, potential loss of 50%.
B looks more exciting on the surface, higher ceiling.
Yes, but look at the downside. If you're wrong on B, you lose half. If you're wrong on A, you lose 10%. Same effort, very different damage when things go wrong.
So B needs to be right far more often just to break even over time.
Exactly. And this is how the best investors think. They're not trying to win every time. They're trying to make sure that when they're right, they win meaningfully. And when they're wrong, they lose as little as possible.
Win big, lose small.
Over time, that ratio matters far more than being right on every single call. Because long-term returns are often determined not by how much you gained, but by how much you avoided losing.
You protect the downside, and the upside takes care of itself.
That's the whole game.
Okay, I want to go back to something you said. Remember 2020?
The market crashed over 30% in a matter of weeks.
People panicked. Many sold.
And then the market recovered. Fast. The people who sold locked in their losses permanently. The people who stayed invested recovered fully, and then kept going higher.
That wasn't a test of investing knowledge.
It was a test of emotional control.
And most people failed it, not because they were stupid.
Because they weren't prepared for how it would feel. Reading "Markets down 30% on a screen" is one thing. Watching your actual savings numbers shrink by a third, in real life, in real time, that hits completely differently.
Your stomach drops. You start doing the maths at 2 a.m. You think, I have to do something.
And in that moment, fear overrides logic. You sell, you lock in the loss, and you turn a temporary dip into a permanent one.
So the emotional preparation is as important as the financial understanding.
Maybe more important, because knowledge alone doesn't stop panic. Preparation does.
So how do you actually prepare? How do you figure out how much risk is right for you?
For me, I ask 3 questions, honestly, before invest anything. What's my timeline? When might I actually need this money? 5 years? 20? Short-term money cannot afford big swings. Long-term money? Short-term drops become noise.
Because the hill is long enough for the snowball to keep rolling. We talked about this in episode 6.
Exactly that. Question 2. Can I genuinely sleep through a 30% drop? Not, should I be able to? Can I honestly leave it alone and wait? Because an investment you panic sell at the bottom is worse than a lower risk investment you hold calmly through a dip.
The best investment isn't the one with the highest return. It's the one you can actually stick to.
I love the way you put that. Yes, that's exactly it.
3.
What's my actual situation right now? Because the same investment can be completely right for one person and completely wrong for another.
Give me an example.
2 people. A fresh graduate just started working, and his father almost at retirement age. Same investment product.
Different answer.
Yes, the young person still has decades to earn, save, and recover from any loss. Time is on his side. He can afford to ride the waves.
So maybe more stocks, less cash.
Exactly. The father, close to retirement, fewer earning years ahead, can't afford a big loss right before he stops working. He keeps more in stable things, even if the returns are lower.
Same product, same market, completely different right answer.
Which is why "what should I invest in" is always the wrong first question. The right first question is, what's right for me, given where I am right now?
Very true. And I want to say something, because I think people hear high risk and immediately think avoid at all costs.
That overcorrection is its own trap, because avoiding all risk above cash just means you're choosing inflation risk instead. You're not escaping risk, you're choosing a different kind.
You're always choosing a kind of risk.
Always. The goal isn't to avoid risk. The goal is to manage it, consciously. Spread your investments. Don't put everything in one place. Match the risk to your timeline. And before anything, ask honestly, does the potential upside justify the potential downside for me right now?
That one pause, that one question.
That's risk management. That's genuinely all it is.
Warren Buffett once said, risk comes from not knowing what you're doing.
That is so powerful.
Not from the market, not from the economy, not from external forces, from not knowing.
And that's the shift. The more you understand what you're buying, how it makes money, what can actually go wrong, what the realistic range of outcomes looks like, the more clearly you can evaluate the risk. Knowledge doesn't eliminate risk, but it makes it visible. And visible risk is manageable risk.
Invisible risk is the dangerous kind.
That line, I want to put that on a wall somewhere.
You can borrow it.
Thanks. The less likely you are to be the person who panics in 2020 and sells at the bottom, the less likely you are to be the person who almost sent money to a countdown clock.
3 minutes. It almost had me.
Arm your brain first. Think risk first, then return.
Then your money follows.
Okay, one action this week. Before you touch any investment, write down 3 things. What is my timeline? Can I genuinely sleep through a 30% drop? And does this actually fit my situation right now?
Think risk first, then return.
Because the goal isn't to get rich quickly.
It's to stay in the game long enough to get rich slowly.
And that's how real wealth is built.
If this episode gave you a filter you didn't have before, share it with someone who needs it. Give this episode a like and subscribe to the Easy Wealth podcast. It really helps us keep making these conversations for you.
Take care of your finances and take care of yourselves. See you next week. Bye.